In this video, we're going to complete Part C and get through Part D as best we can. Part C really is just prepare and adjust the trial balance. So kind of reviewing Part A, we did the journal entries, these numbers which tell us what happened, what the transactions were. Part B, post the numbers to the relevant accounts in the ledger. And then we're going to take these final ending balances and put them in the trial balance. So this 39.9, so here's what the trial balance is. We just list all the accounts and we write that if it's a debit balance, we put it in here. Notice liabilities will have credit balances, but we're just copying this balance, this balance, this balance, this balance, and now we start the credits, 1,700, 12,000. So we just copy each of the balances and then we add them up to make sure they equal. We do this because now it's going to make writing out the financial statements really easy. All the assets are listed, all the liabilities. So, that's much of the balance sheet right there. Okay. Now, let's review the financial statements before we actually write them out. So here's our skeleton of the financial statements. The income statement, all we're doing is taking revenues minus expenses. That's our net income. The second statement we write out is a statement of changes in stockholders' equity. There are two components, right? Common stock, retained earnings. And we're just showing and reporting what changed these accounts. So we start with the beginning balance and then add or subtract what changed it. Well, the only thing that changes common stock is issuing it, and that causes it to go up. So we take beginning, add what we issued, and that gives us the ending. For retained earnings, start with the beginning. It goes up because of profits, and it goes down because we distributed those profits. So the reason why we do the income statement first is we're going to take this net income and we will carry that number forward into the statement of changes in retained earnings. So then we get our ending common stock, our ending retained earnings, and then we'll add those two numbers together, the two ending numbers, to get total stockholders' equity. The third financial statement is the balance sheet. We know the balance sheet is assets equal liabilities and stockholders' equity. So we'll have a heading of assets. We'll list all the various ones out, like cash, accounts receivable, supplies, etc. And then we will add those up. And then we'll list the liabilities, like accounts payable, unearned revenue, etc. And then we will add those up as well. Stockholders' equity is common stock and retained earnings. So the balance sheet is at a point in time. So it's going to be dated the very last day of the accounting period. So at the end of the month, at the end of the year, whatever, at that point in time. These two statements cover a period of time. So it could be a month, a year, whatever. But the income statement and statement of changes, they're like a movie that covered a period of time. The balance sheet's a snapshot, click, click, at that point in time. So here again, the reason it's the third statement we prepare is we get the updated common stock and retained earnings balances, and those will move forward to the balance sheet. So I take that number and put it in there, and I take that number and put it in there. Okay, so then my total assets will equal my total liabilities and stockholders' equity. That's our balance sheet. The fourth statement also covers a period of time. Statement of cash flow. We've kind of gone over, we're going to, the operating activities, cash in and out for that. Investing, cash in and out for that. Financing, cash in and out for that. I'll quickly go back and review that from a prior lecture, though. So operating, any cash received from right? Revenues and expenses are our main operations of our business. So any cash coming in from those or cash going out for those gets labeled gets labeled operating. Financing, we finance assets with debt and equity. But most specifically, it's going to be long term. So finance is activity if we have cash coming in from borrowing, or we have cash paid to reduce our loan, or cash coming in from selling stock, or cash paid, paid to the shareholders. Cash receipt from the shareholders because we sold them stock. Cash paid to shareholders because we issued dividends. So anything with long-term debt and stockholders' equity, cash coming in, cash coming out, is a financing activity. And then the last one, if this is financing, these assets, if there's long-term assets, that's the company's investing. It could be investing in stocks and bonds, but it might be buying buildings or land. So cash paid to buy those long-term assets, or if we sell those, cash received from selling those. So that's connected into here. We have all those cash flows listed. We look at the net, so we net all those numbers together. What's the net change? We add the beginning balance, and then we get our ending cash balance. So this ending cash balance here, those two should agree. If they don't, we've made an error. So the ending cash balance on the cash flow statement should agree with what we reported as ending cash on the balance sheet. Okay, so let's go back to our homework problem and look at the income statement and look at what they did. So on the income statement, right, that's going to be these revenues and expenses. So I'm going to take these four accounts here and put them on the income statement. So I have my revenue, and then I'm going to indent my expenses because I want to add the expenses and bring the total over to the right. So in the right-hand column, I'll see revenue minus total expenses equals net income. Also note the date for the year ended December 31st, so it's telling this is for a year. All right, next one, statement of changes. So let's go look at what we will be doing. So we have beginning common stock. I'm actually going to have to go back and look at the stock account. I'll have to go back to the ledger and see that we issued $45,000 to get that actually on that financial statement, 45, and the ending balance is 45,000. Beginning retained earnings was 0, and then we're going to take this net income number. So I go back to my income statement, the 50,880, and I will bring that number forward and put it in here. There were dividends, and again, I know that from this trial balance, there were dividends of 15,000. So beginning plus net income minus dividends and gives us our ending. So I'm going to add ending common stock to ending retained earnings to get total stockholders' equity. Now remember, ending common stock, ending retained earnings will go forward to the balance sheet. The balance sheet has the assets, liabilities, stockholders' equity. Here's our common stock and retained earnings. Just refresh our memories, the 45, 35, 880. We plug those in here. But I will, to get these assets, I'm going to go back, right? Here's cash. Here's all the assets. So I'm going to list all of those for my balance sheet. And then I add up total assets to the right. These three liabilities, and again, I go to my trial balance, and I've got these three, and I'm going to report them on my balance sheet, and then I add up liabilities. We've already done the stockholders' equity, and then add that up. So here's my total assets. I add up total liabilities and stockholders' equity, and then I get ending stockholders' equity. Okay, and then the last financial statement we'll do is the statement of cash flow, where we do the three activities. So we're going to see operating, investing, and financing. Theoretically, we're going to have, here's the positive cash coming in, here's the cash going out, so cash in and cash out. We didn't identify at the time operating financing, although we did do that when we were doing the horizontal model. Oop, went past it. So the 45,000 financing. So let's see, we have 1, 2, 3, 4, 5, 6 operating activities. Let's go look and see how the solution wrote those up. Okay, so it added up the positives, the 47.4, and then added up the negatives. So again, you could just merely, these that were operating, let me just circle them here. So let me do the positives. 24,000, 8,400, and then this 15,000. 24,000, 8,400, and 15,000. There's our 47.4. And then the negatives, the cash outflow, was this 24,000 and then this 15. I'm just looking over here. It's an operating 15. And then another negative was this 12. So 24, 15, and 12. Hang on a minute. Okay, I think I caught my mistake. 24,000, 1,500, 24,000. Oh, excuse me. Cash going out. 24,000 cash out. This is a 1,500, and then this is a 12,000. And then those will total to this 37.5. Okay, and then I'll have net cash from operating. And then the only other one we had was this 45,000 financing for issuing stock. And then that's listed under, so there were no investing. And then there was this financing one. Oh, I guess there was the dividend. I forgot. Yep, here we go. A dividend, 15,000 for cash going out. Okay, so then they add up operating, investing, and financing. The net change is 39.9. There was no beginning balance, so the ending cash is 39.9. Let's make sure that agrees with what's on the balance sheet, and it does, 39.9.